There are moments in economic history when things feel slightly unreal, not panicked, not euphoric, just unbalanced. That is where we seem to be right now. Everyone seems to think that artificial intelligence is a bubble at the moment, but what makes this belief unusual isn't how widespread it is, it's who is saying it. Normally, when bubbles form, warnings come from outsiders, skeptics, critics, people who feel left behind. This time, the warnings are coming from the inside. Sam Altman, the CEO of OpenAI, has openly acknowledged that AI investment may be running ahead of economic reality. Jeff Bezos has admitted that expectations around AI could be excessive. Mark Zuckerberg has cautioned that much of today's AI spending may not generate near-term returns. These are not people with incentives to talk down their own industries, and yet they are. Even more striking is the fact that institutions like the International Monetary Fund and the Bank of England, organizations that typically avoid speculative language, have started issuing formal warnings about AI-related financial risks. That alone should give us pause. Because these institutions exist to prevent systemic crises. They do not comment lightly. So in this video, we're going to slow down and look carefully at what's happening. We're going to explain why AI looks like a bubble, why the size of that bubble may be unprecedented, and why, if it bursts, the consequences could extend far beyond Silicon Valley into the heart of the U.S. economy, and from there, the rest of the world. This is not a video about whether AI works. It's about economics, capital, and risk. Part I, what a bubble actually is. To understand why AI might be a bubble, we first need to understand what bubbles really are. A bubble is not simply hype. It is not optimism, and it is not even speculation by itself. Historically, bubbles form when capital flows into an industry faster than its ability to generate real economic returns. Crucially, bubbles often form around technologies that genuinely matter. Railways mattered. Electricity mattered. The internet mattered. Yet all of them experienced devastating bubbles. The reason is simple. Markets price the future, but finance the present. When future expectations grow too large, too fast, the present can no longer support them. That gap between expectation and cash flow is where bubbles live, and AI today sits squarely inside that gap. Part II, the scale of the AI build-out. Let's start with the numbers. In 2025 alone, companies in the United States are expected to spend roughly billions on AI data centers. This is not spending on apps or software updates. This is heavy industrial investment. Concrete, steel, power generation, cooling systems, high voltage transmission lines, and above all, semiconductor chips. This level of spending is historically rare. According to Morgan Stanley, cumulative spending on AI data centers and related infrastructure could reach $2.9 trillion by 2028. McKinsey's estimate is higher, still $6.7 trillion by 2030. To put that in perspective, this is on par with the interstate highway system, the post-war housing boom, the global fiber optic rollout. And yet, AI infrastructure is being built before demand has fully materialized. Part III, where the money isn't. Now compare this to AI revenue. According to The Economist, total AI-related revenues in 2025 are expected to be around $50 billion. That includes enterprise subscriptions, cloud AI services, licensing fees, APIs, consumer tools, everything. That means we are investing $7 to $8 for every dollar AI currently earns. Historically, the telecom bubble peaked at to 4 times revenue. The railway bubble peaked at 2 times. AI exceeds both. This implies that AI revenues must grow at extraordinary speed for many years without interruption. No slowdown, no margin compression, no regulatory drag. That is an enormous assumption. Part IV. Why this gap is dangerous. Investment is not neutral. When capital is misallocated, it doesn't disappear quietly. It creates debt, asset bubbles, labor distortions, financial fragility. If AI revenues fail to materialize quickly enough, investors face write-downs. Write-downs lead to lower equity prices, reduced lending, hiring freezes, capital flight. This is how sectoral bubbles become macroeconomic problems. Part V, the financing structure. The second major warning sign is how AI is being financed. The NVIDIA OpenAI loop. In late September, NVIDIA agreed to invest up to $100 billion in OpenAI. OpenAI, in turn, agreed to purchase millions of NVIDIA chips. Money flows out, money flows back in. This is not illegal, but it is concerning because it suggests that demand may be internally generated rather than externally validated. Bloomberg analysis shows NVIDIA has similar relationships with many major AI firms. This begins to resemble a closed financial ecosystem. Extreme valuations. Mira Murati's new AI startup raised the largest seed round in history at a $10 billion valuation. No product, no revenue, no disclosed roadmap. This is not venture capital as it once existed. It is speculative capital, chasing perceived inevitability. Hidden leverage. Meta and Microsoft companies with massive cash flows are now using private credit, special purpose vehicles, off-balance sheet financing. This allows borrowing without fully revealing leverage. When large firms hide debt, it usually means markets would react poorly if they didn't. That alone is a warning sign. Part VI, AI, and the US economy. Here is where this stops being a tech story. The US economy has four components. 1. Consumption. 2. Investment. 3. Government spending. 4. Net exports. AI is propping up 2 of them. Investment dependency. AI-related spending accounts for roughly 40% of recent US GDP growth. That is extraordinary concentration. If AI investment slows, GDP growth slows. Consumption via wealth effects. AI stocks account for roughly 80% of S&P 500 gains. The top 10% of Americans now account for 50% of all consumer spending. That means consumption is increasingly driven by asset prices. If stocks fall, spending falls. Wealth exposure. Nearly 30% of household net worth is tied to equities. Foreign investors hold unprecedented amounts of US stocks. This is systemic exposure. Part VII. Why this time is different. In past crises, the US benefited from safe haven status. Capital fled to America. Today, debt is higher. Political risk is higher. Fiscal space is smaller. The old response playbook may not work. Part VII, the good bubble argument. Some argue AI is a productive bubble. Railways survived their crash, fiber survived its crash. But AI infrastructure is different. Chips account for 60% of data center costs. Chips depreciate rapidly. If demand falters, investors are left with obsolete assets, not timeless infrastructure. Conclusion, a fragile center, AI will reshape the world, but bubbles do not require technologies to fail. They only require expectations to overshoot reality. Right now, AI sits at the center of investment growth, market confidence, consumer spending, global capital flows. That makes it powerful and dangerous. Part 2, the great AI build-out. How trillions of dollars are being spent before the money shows up. Section 1, when capital moves faster than demand. Once a technology captures the imagination of capital markets, money begins to move at extraordinary speed. Not gradually, not cautiously, but all at once. Artificial intelligence reached that point sometime in the early 2000s. What began as a promising research breakthrough quickly transformed into a full-scale industrial race, one not just for software dominance, but for physical infrastructure. This is an important distinction. Many people still think of AI as something abstract. Algorithms, models, chatbots, code running quietly in the cloud. But modern AI is anything but lightweight. It is one of the most capital-intensive technologies ever deployed. Every large AI model requires vast amounts of vast computing power, electricity, cooling, networking, and physical space. And all of that has to exist before the AI can generate revenue. This is where the story begins to resemble past bubbles, not because AI lacks value, but because the sequence of investment and payoff is inverted. Section 2, the data center gold rush. At the heart of the AI boom lies the data center, not the data centers of the early internet era, small, modular, relatively cheap. These are industrial scale facilities, sometimes consuming as much electricity as a mid-sized city. In 2025 alone, companies in the United States are expected to spend around $400 billion building and expanding AI-specific data centers. That figure is difficult to grasp. So let's slow down and contextualize it. This is not annual spending on consumer gadgets or software updates. This is land acquisition, massive construction projects, custom power infrastructure, cooling systems measured in megawatts, and hardware purchases counted in the millions of units. And importantly, this spending is front-loaded. Once a company commits to a data center, most of the cost is incurred long before any revenue is earned. Section 3. Why AI data centers are different. Historically, data centers were built in response to demand. A company saw traffic increase, servers filled up, new capacity was added incrementally. AI flips this logic. Large AI models require enormous scale from day one. Training a single frontier model can involve tens of thousands of GPUs, months of continuous operation, and electricity costs running into the tens of millions of dollars. As a result, companies are building infrastructure speculatively, assuming demand will arrive later. This is a critical shift. When infrastructure is built after demand, risk is limited. When infrastructure is built before demand, risk accumulates silently. Section 4. The numbers keep getting bigger. According to analysts at Morgan Stanley, total spending on AI data centers and related infrastructure could reach $2.9 trillion by the end of 2028. McKinsey's estimate is even more aggressive, $6.7 trillion by 2030. To understand the scale, that rivals the entire U.S. interstate highway system. It exceeds the inflation-adjusted cost of the Apollo program. It approaches the scale of global energy infrastructure buildouts, and yet, this is all being built for a technology that, as of today, generates relatively little revenue. This mismatch is not subtle. It is the central tension of the AI economy. Section 5, where the revenue is supposed to come from. Supporters of the AI boom argue that revenue will eventually arrive from several sources: enterprise subscriptions, cloud AI services, productivity tools, automation, licensing and APIs, and these revenue streams are real. The problem is scale. According to the economist asterisk, total AI-related revenue in 2025 is expected to be around $50 billion. That includes consumer AI subscriptions, enterprise contracts, cloud usage fees, model licensing, everything. When placed next to hundreds of billions in annual investment, the imbalance becomes obvious. In simple terms, AI investment currently exceeds AI revenue by 7 to 8 times. Historically, this ratio is extremely high. Section 6, historical parallels. During the 19th century railway boom, investors poured money into tracks, bridges, and rolling stock. Railways transformed economies. But even then, investment rarely exceeded twice expected revenue. During the late 1990 seconds telecom bubble, companies laid vast networks of fiber optic cable. That infrastructure later became essential. But at the peak, investment was roughly 4 times revenue. Both bubbles ended with bankruptcies, asset write-downs, mass layoffs, and long periods of stagnation. AI exceeds both ratios, which means the margin for error is smaller. If revenue growth slows even modestly, the financial math collapses quickly. Section 7. Why future value doesn't pay today's bills. One common argument is that AI's true value lies in the future. That may be true, but infrastructure is paid for in the present. Loans accrue interest now. Depreciation begins immediately. Electricity bills arrive every month. Capital markets can tolerate delayed returns, but only for so long. When cash flows fail to materialize, investors demand answers. And when answers are vague, confidence erodes. Section 8, the power problem. Another often overlooked constraint is electricity. AI data centers are among the most energy-intensive facilities ever built. Some single campuses require gigawatts of power, dedicated substations, long-term energy contracts. In several regions, AI data centers are now competing directly with households and industry for electricity. This creates political resistance, regulatory delays, infrastructure bottlenecks, all of which slow deployment and raise costs. Higher costs mean lower margins. Lower margins mean weaker returns. Section 9, why scale doesn't automatically fix this. Optimists often argue that scale will solve everything. As AI usage grows, costs per unit will fall. This is true up to a point, but AI faces diminishing returns. Larger models cost exponentially more to train. Performance gains become incremental, and competition compresses pricing. At the same time, customers push back. Many firms discover that AI tools don't always replace labor, require significant integration, and deliver uneven productivity gains. That slows adoption. And slower adoption is fatal to speculative infrastructure buildouts. Section 10, when investment becomes a macro problem. At this stage, the AI boom stops being a technology story. It becomes a macroeconomic one, because investment is one of the 4 pillars of GDP. When investment surges, growth looks strong. When it collapses, recessions follow. AI-related spending now accounts for a remarkably large share of recent U.S. investment growth. That concentration creates fragility. If AI spending stalls even temporarily, the shock will ripple outward. Construction slows, suppliers suffer, energy markets shift, labor demand weakens. This is how sectoral booms turn into economy-wide slowdowns. Section 11, the quiet buildup of risk. Bubbles rarely announce themselves. They grow quietly, supported by optimism, incentives, and momentum. In AI's case, the risk is not obvious day to day. Data centers are still being built. Stocks are still rising. Revenue is still growing, just not fast enough. But the gap remains. And gaps like this tend not to close gently. Part 3, the financing illusion, how money, leverage, and circular capital are holding the AI boom together. Section 1, when booms stop being self-funding. At a certain point in every major economic boom, something subtle changes. Early growth is funded by real demand. Later growth is funded by expectations. And eventually, those expectations begin to fund themselves. That is the point where risk quietly accelerates. In the early stages of the AI boom, spending was easy to justify. Cloud providers saw real usage, enterprises experimented with automation, consumers paid for subscriptions. But as the scale of investment exploded into the hundreds of billions and then trillions, AI stopped being something that could be financed organically. The cash flows simply weren't large enough. So the industry did what every capital-intensive boom does when it outgrows its own revenues. It turned to financial engineering. Section 2, the role of debt in modern tech booms. For decades, large technology companies were unusual. They were growth companies that didn't rely heavily on debt. Firms like Microsoft, Google, Apple, and Meta generated enormous cash flows and funded expansion internally. That is no longer the case. AI infrastructure is so expensive that even the largest tech firms have begun borrowing aggressively, not always openly and not always transparently. This shift matters because debt introduces fragility. Debt must be serviced regardless of whether revenue meets expectations. Section 3, why straightforward borrowing isn't happening. Under normal circumstances, a company like Microsoft or Meta could issue bonds easily. They have strong credit ratings. They have deep investor trust. They could borrow at reasonable rates. So why aren't they doing that at scale? Instead, many AI investments are being funded through private credit firms, infrastructure funds, special purpose vehicles, joint ventures, and off-balance sheet structures. These arrangements allow companies to delay recognition of debt, shift risk elsewhere, and keep reported leverage lower. This does not make the debt disappear. It simply moves it out of sight. Historically, when companies go to great lengths to hide leverage, it is because markets would react poorly if they didn't. Section 4, Special Purpose Vehicles and Financial Distance. Special Purpose Vehicles, often called SPVs, are not inherently bad. They are commonly used in infrastructure projects, real estate, and large capital investments. But they can also be used to create financial distance. An SPV allows a company to say, technically, this debt isn't ours. Even if the company is the primary customer, the company guarantees demand and the company benefits from the asset. In the AI boom, SPVs are being used to finance data centers, purchase chips, and secure long-term power contracts, all while keeping those obligations partially or fully off corporate balance sheet. This reduces transparency, and reduced transparency increases systemic risk. Section 5, Private Credit steps in. Another major player in AI financing is private credit. Private credit firms lend money outside traditional banking channels. They are faster, less regulated, more flexible, and they thrive when traditional lenders hesitate. AI infrastructure has become a perfect target. It requires enormous upfront capital, promises long-term returns, and is backed by prestigious tech clients. But private credit also comes with higher interest rates and stricter conditions, which means higher fixed costs and greater vulnerability to revenue shortfalls. If AI revenues disappoint, private lenders will not be forgiving. They will enforce contracts. Section 6, the NVIDIA.OpenAI loop. One of the most discussed examples of AI's financial complexity is the relationship between NVIDIA and OpenAI. In late September, NVIDIA agreed to invest up to $100 billion into OpenAI. OpenAI, in turn, committed to purchasing massive quantities of NVIDIA chips to power new data centers. This creates a loop. Capital flows from NVIDIA to OpenAI, then flows back to NVIDIA as revenue. On paper, both sides benefit. But economically, this raises uncomfortable questions. Is this revenue driven by independent demand or by reciprocal obligation? Circular capital flows are not inherently fraudulent, but they distort signals. They make demand look stronger than it really is. Section 7, Why Circular Financing is Dangerous. Markets rely on price signals. Revenue tells investors what customers actually want. When revenue is sustained by reciprocal financing, those signals weaken. In extreme cases, companies end up investing in their own customers, guaranteeing their own sales, and validating their own valuation. This does not require malice. It emerges naturally when capital is abundant, expectations are high, and everyone fears being left behind. But history shows that circular financing structures tend to unravel suddenly. When one participant pulls back, the loop breaks. Section 8, Sky-high valuations and the loss of discipline. Another hallmark of late-stage booms is valuation detachment. Mira Murati's new AI company raised the largest seed round in history at a $10 billion valuation. No product, no revenue, no public roadmap. Investors reportedly accepted this because the founder was respected, AI was perceived as inevitable, and scarcity psychology had taken hold. This is not how capital allocation normally works. Early stage investment usually prices uncertainty. Here, uncertainty was ignored. That is a warning sign. Section 9, Inevitability as an investment thesis. In many bubbles, investors stop asking whether something will generate returns. They assume it must, because the technology feels inevitable. The railroad was inevitable. The internet was inevitable. AI may be inevitable too. But inevitability does not guarantee timing, profitability, or returns on capital. Many railroads went bankrupt. Many telecom firms disappeared. Infrastructure can be essential and still destroy investor capital. That distinction is often forgotten during booms. Section 10, Who holds the risk? As AI financing becomes more complex, risk spreads. It moves from tech companies to lenders, to infrastructure funds, to pension funds, to insurers, and eventually to households. This diffusion makes the system look stable, but it also makes it fragile. When losses occur, They surface everywhere at once. Section 11, why this doesn't look like 2000. Some argue that AI is different from the dot-com bubble, and in many ways, it is. Today's tech firms are profitable. Their balance sheets are stronger, their products are real, but the structure of risk is different. Instead of venture capital failures, we may see infrastructure write-downs, credit stress, and capital spending collapses. Those hit the real economy faster. Section 12, the silent dependence. AI financing doesn't exist in isolation. It interacts with stock prices, corporate earnings, consumer wealth, and pension returns. This creates silent dependence. If AI financing stalls, markets feel it quickly, even if AI itself continues to exist. Section 13, why booms end quietly at first. Bubbles rarely pop overnight. They deflate, projects get delayed. Spending slows. Guidance softens. The danger is not collapse. It is erosion. Confidence fades. Capital retreats. Momentum reverses. And when leverage is involved, reversals accelerate.